So today we are going to be looking at or commencing a new topic, which is IAS 12 on income taxes. Remember that last week we rounded up on IAS 36 on impairment of assets. And I can remember vividly that I gave you an assignment to solve a question. So I haven't seen any solution from you guys. So you have to try it. And as it is now, it seems we are now carrying over a lot of assignments. And now this is now the second week in August. And it seems we are now covering so much. Now tonight, we're going to move very far again on IAS 12 income taxes. So by introduction, by introduction, so all of you here are not new to taxes. You are fully aware about what tax is, and by general meaning, without bias to or being specific about definition from reporting, generally we see taxes as compulsory levy that is payable by residents of a nation. Now, residents of a nation might be an individual or an enterprise or a company, but the reality is that taxes is even beyond just residents alone. Even non-residents pay taxes. So you actually pay taxes on any money you make in Nigeria. But today's class is not about the tax laws. So this definition can still fly, just to have an idea of taxes. So the taxes as you know it includes there's company income tax. There is the one that is an advance payment of company income tax, which is withholding tax. There's personal income tax. There is capital gains tax. There is value added tax and others, and a lot of them. So it will not be totally right if I tell you that what I want to teach you today is how to account for all of these taxes. That won't be right, because the focus of IAS 12 is accounting for company income taxes. That's the major focus, and you would see that that's what the examiner will ask you. It's around company income tax majorly. Now, having identified that the focus of this standard is company income taxes, then let's establish some ground rules. Let's establish some definitions that would be very important to us all through our study of IAS 12. And the very first of these is something we call taxable profits. And taxable profits are profits that are determined using the rules of the taxing authority or by compliance with the tax laws. So that's the first thing we need to establish. And we're going to be working with these taxable profits. They are the profits that are determined using the rules of the taxing authority or by compliance with the tax law. So they are calculated by complying with the tax laws in Nigeria, of course. So, um, of course, you need to be able to a large extent, calculate taxable profit at a very simplistic level. For example, now, you need to have a general understanding that depreciation are usually a disallowable expenses that usually would be added back, and the taxman would hand you over capital allowance. They will say you can then deduct that. At least at a very basic level, you need to be able to do that to arrive at your taxable profit, even though there are other disallowable expenses, and also there are other even non-taxable income that are usually adjusted for in deriving the taxable profit. Also, before you can derive your taxable profit, we usually would start from the accounting profits. So accounting profits, you can say this is, hold on, we can say this is synonymous to the profit before tax, or it is the profit before deducting the income tax. So accounting profit is the profit before you deduct income tax. That's accounting profit, which is synonymous to your profit before tax. Also, is then income tax. You see, income tax is the aggregation of the current tax and deferred tax. Is the aggregation of the current tax and income tax. So, and coincidentally, this standard is talking about income taxes. So when we say income tax, we are talking about a combination of both current taxes and your deferred tax. Together, they make up the income tax. Then, having known that the income tax is current and deferred tax, that means everything I want to teach you today is all about current tax and deferred tax. Then, this current tax is a tax that is payable or recoverable in the current period in respect of taxable profit. In respect of taxable profit. In respect of taxable profit. That's your current tax. Is a tax that is payable or recoverable in the current period in respect of taxable profit. Then we have deferred tax. See, this is also a tax that is payable or recoverable in the future period in the future period, in respect of temporary difference. In respect of temporary difference. So that's deferred tax. This is a tax that is payable or recoverable in the future period in respect of temporary differences. Okay, the only thing left here is for me to explain temporary difference, but that will take a lot of explanation. So I will just wait until I get to deferred tax, then I would critically explain temporary difference. But for now, just take it as this. So majorly, everything we want to talk about today is inside all of these definitions from taxable profit, even though I will not really start teaching you how to determine taxable profit. It's really outside the scope of IAS 12. It assumed that you should be able to determine your taxable profit, and you also find out that in your exams, mostly they would give you that taxable profits, except in few cases, which is rare. So they will mostly give it to you, and we are more focused on your accounting for that current tax and deferred tax. Okay, so let me start with current tax. Let me start with current tax. Okay, let me see. I think I have a message. Yeah, Christopher said I should increase the font size. Okay, let's see if we can increase it. Let's see if we can increase it to 12. Christopher, is this okay?
It's okay. Yours are to zoom in. Sorry, I used the wrong language. To zoom in.
Okay,
It's
I'm
to
already
so
at,
that when we are rewashing, sometimes we'll be fixing
oh, okay. Let me see. It's already at 200%. Let me see.
it's okay.
Okay,
Many of us use less.
okay.
Thank
All
you.
right. Okay. Okay, so let us start with current tax. Let's start with current tax. So, like we have mentioned before, that this tax is a tax that is payable or recoverable in respect of taxable profits. And when you have current taxes, the way it is recognized as below, is recognized by um, like a deduction from your profits. So usually we would say like you're debiting your income taxes because it's part of your income tax that you're going to debit from your POL, and you're going to credit a current tax liability, or let me call it current tax payable, which would show in your statement of financial position as a current liability. And this tax is measured using the tax rates applicable in your jurisdiction at the year end. In your jurisdiction at the year end, in Nigeria, the tax rates, the tax rates is 30% in Nigeria. So in Nigeria, it's just a matter of applying your 30% on your on your taxable profits at the end of the day. That simply gives you your current tax. So current tax is quite straightforward, right? However, however, um, the only challenge we have with current taxes is that they are usually not paid that year. They are usually not paid that year. And the reason why they are not paid that year is for two reasons. Number one, you would need to determine your taxable profits, meaning it's only after the year end that you can determine your taxable profits, right? So you would need to determine your taxable profit before it is determined. And number two is that the law in Nigeria requires that you should file your returns 6 months after your year end. So it's usually expected that is at the point when you have filed your returns, then you can then pay. So in Nigeria, we usually do that through the tax promax. So you will see that it's your taxes for 2024, for example, now companies would then be paying it in 2025. So something usually occur during that period, which I will show you very soon. So I need to attend to Charity. So Charity, you raised your hand. You want to ask a question?
Yes, good evening, sir.
Hi, how are you?
I'm fine, sir. So you said the tax rate is 30%. So my
Yes.
question is it applicable to every firm, both
It's
the
not
big
applicable.
and the small, both the um
Um,
medium-sized firm?
it's not applicable to every firm, but I don't want to dwell on that because that's not our focus here. So the man teaching you tax would focus on that. So I don't know, let us focus on the
No, I'm not
wrong.
taking tax class.
Okay, so it won't affect you here. So again, it depends. There is nil depending on your turnover. So a company that is earning less than 25 million turnover is not exempted from company income tax. If your revenue is between over 25 or less than 100 million, you do 20%. If it's over 100 million, you do 30%. Okay. But that is not relevant here. Okay. In the exam, they will just tell you nobody's going to start assessing you for that in this one. So don't bother about that, right? Which is why I'm not dwelling on that. So I just looked at the rate that is popular, which is the 30%. Even from next year is going to change again, using the Tax Reform Act, but that's not the focus here. Okay, so as I was saying, right, current tax is quite straightforward, but the only challenge is this, right? You don't pay it that year, you would pay it the next year. So, therefore, what you are doing, this thing that you can see, this journal entry you are seeing me passing, is merely an estimate of tax. What you're doing, we usually refer to it as estimate of your current tax, because the only body that will determine your final tax is the relevant tax authority. So the way it happens is this. If this your journal entry, let's say for example, so the estimate of current tax is okay. I can see among me. You can go ahead, please. Among me.
Good evening, sir.
Good evening.
Yeah, apologies. I joined the class late, so I'm struggling with the topic we are treating. So I don't know if I've really missed much or.
No, you have not. You're lucky. We're just starting. You have not missed at all. So what you're seeing on the board is the most important thing I've said so far. I've not really said much. So just mute and continue listening, right? You have not
Oh,
missed anything.
all right.
Yeah.
Okay, thank you.
Okay. Yeah. So we're just starting current tax. So I'm just trying to explain the way it works. So all I've mentioned so far really is this is the way you recognize current tax at the end of the year. And I was explaining that it's not a tax you pay that year, you pay it the next year. So what you're basically doing is an estimate of current tax. You're just estimating your tax. So I'm trying to put in figures with it. So what I'm saying is here that at the end of the year, let's say you estimate your current tax in 2004 as 100,000. And the way you know that the way this works practically is that when you prepare your account, your management report at the end of the year, you probably will send it to your tax consultant if that company has one. If they don't, they will just do it in-house. So usually large companies will send that management report to their tax consultant. So it's the tax consultant that would compute the taxable profit from the accounting profit and would end up with a current tax that they are supposed to put in into their management report. Then when the auditor comes, the auditor then does their work, do all the auditing, then they eventually file return. Okay, so when they file returns, they are still going to file based on this 100,000, right? So immediately you file, I mean, like right now, a lot of companies are already getting desk review report from FIRS. Like a lot of my clients already get almost all of them. So as soon as you file your returns, FIRS will review it and they will send you a desk review report that, okay, oh, we have studied your financial statements and this is what we feel should be your taxable profit and this is what your tax should be. Okay, so presumably is the tax authority that will determine your final taxes. So you can argue. Eventually, you guys will agree. So let's say the actual tax agreed with the tax authority is 120,000. Okay, so that means that what you should pay now is 120 and not 100,000. So what's happening here is this. Remember that with this 100,000 in your books, you have already recognized it as P&L, and that's last year. And you are having a current tax payable of 100,000. In some cases, it will have been paid off. It will have been paid off by the time these guys are coming. You will have paid off these 100,000. So if I may ask you, let's say after you filed your returns, you then pay these 200,000. Okay, I said 200,000. This 100,000. Let me see. Is there anybody that can tell me what would be the double entry to net off this 100,000? Let's say you pay this 100,000. What would be the double entry to net stuff?
I
So
think
when it's
you
100,000,
debit current tax,
you would debit
current tax payable.
current tax payable. Okay.
Mm,
Credit bank, abi?
yes.
Yeah, correct. So it will have it is expected that companies should have done that even before the desk review comes. So you should have cleared off that payable. Now, when these guys come with and say, no, your actual tax is 100,000. So they will now say yes, we know that of this 100,000, you have paid 100 because it will be there on their record. They will now see that you are owing 20,000. They will say that you are owing 20,000. So since you are owing this 20,000, for us accountants, you will need to pass that excess 20,000 into your books as an additional liability, right? So since they say you are owing, let's say you then credit like a current tax payable. What do you debit? Because this is happening during the year. So you would need to put this in your ledgers. It's not like you will have prepared like a report, so you cannot just put it in P&L. There's no P&L at this point in time. So you usually call this under estimation of tax, under estimate of tax, estimation of tax, of current tax. So what you're doing is you're crediting this and you're debiting under estimate of tax with this additional 20,000 they are bringing for you. With this additional 20,000. Now, this additional 20,000 is expected that you will settle it. Okay? So when the additional tax is settled, just like the person that spoke mentioned, you will then debit that current tax payable again. When the additional tax is settled, you debit that current tax again with that 20,000 to cancel it out. Then you credit your bank again with that 20,000. So what is left here is this ledger, this account under estimate of tax. So when preparing your management reports at the end of the year, the under estimation, the under estimation of current tax will be added to the income tax, for the year. So because this additional tax of 20,000, why I called it under estimate of current tax in the first place is that you actually recognize 100,000 as expense in your P&L, where what you should have recognized is 120,000. So what you did was that you underestimated for tax. You underestimated for tax. So that underestimation, we expect to make it up by, and the only way that can happen is this year. So you will need to add it to income tax of this year. So this is extremely practical. This is how it happens in real life. This is how it happens in your exam, right? So in your exam, you might
Sorry,
not be
sir.
doing all of debit and credit, but this is the way it works.
Sorry, sir. I
Yes,
don't know. Can I ask you? Okay. So
yes.
if you need to make it up, right, do you debit the current year PLL or you debit your retained earnings?
It's the current year PRL that you would debit, not retain earnings.
Even though the tax is payable for the previous year?
Yes, yes.
Okay.
So, yes, you're making a good point, right? But IAS 8, IAS 8 that covers issues around accounting policies, changes in accounting estimates, and errors. So issues around these taxes is outside the scope of that. So if this was, for example, if you are treating this as a change in accounting estimate, for example, now, if it's a change in accounting estimate, we will have treated this as, even with that it will not even be treated retrospectively. It still be treated prospectively. So this is even similar to change in accounting estimates that is usually treated prospectively. So we don't expect you to adjust opening retained earnings or previous year reports. So we expect you to adjust it prospectively. So IAS 8 even covers this, if you look at that in that angle, even though it looks as if, yes, it's based on last year's profits, but it's more like a change in estimates. And IAS 8 says, okay, you're free to treat it prospectively. So which is in line with the way IAS 12 has recommended that we should treat it. So you don't need to adjust opening retained earnings. You actually would impact it on your income tax for the year. That's how it will work.
Okay, thank you, sir. I think it's clear that way.
Yeah. So let's look at a question in regards to that. Okay. So if you look at this question, it says the person that reads for us is the person in class.
Yes, sir.
Okay. All right. Please read. Thank you.
Okay, example 1. In 2017, Lawa Limited had taxable profits of 60,000 naira. In the previous year, 2016, income tax on 2016 profits had been estimated as 15,000 naira. The corporate income tax rate is 30%. Required, calculate current tax payable and the charge for 2017. If the tax due on 2016 profits was subsequently agreed with the tax authorities as A. 17,500 naira, B. 12,500 naira. Any under or overpayments are not settled until the following year's tax payments is due.
Thank you very much. Thank you. So this question required us to calculate the current tax payable and the charge for 2017 if the tax due on 2016 profits was subsequently agreed as this. Any under or overpayment are not settled until the following year. Okay, that's how it works. So if you look at this question, similar to what I was trying to explain to you. So for this company now, the question wants us to calculate the current tax payable and charge for 2017. That its focus is actually 2017. So if I want to do that, they already gave me the taxable profit of 2017. Taxable profit of 2017, they give me as 60,000. And they told me that the tax rate is 30%. So that means the current tax for 2017 is simply 30% times the taxable profit of 60,000. Then I'll be looking at 18,000. So now you see this 18,000, ordinarily we should end here for 2017 because we should just debit P&L income tax for the year and credit current tax payable. It should just end here. This is where it will end ordinarily. But it won't end here because there is this adjustment that has to be made. There is this adjustment that has to be made in respect of over or under estimation of 2016 current tax that are not paid until 2017. So, and that under or overestimation is determined by looking at the estimate of current tax for 2016. We're told that it's 15,000, and they give us two scenarios that the actual tax agreed, that is scenario if the actual tax agreed is 17.5. 17.5. In this case, if it is 17.5, it means that you had underestimated for tax because you are supposed to pay 17.5, or the tax authorities say your tax is 17.5, but what you estimated for was actually 15,000. So what's happening here is that you had underestimated for tax, underestimation for tax to the tune of 2,500. And if you remember what I told you about this 2,500 is synonymous to the tax you then have to pay. It's an additional tax with respect to 2016, and you're paying it in 2017. And I told you that you would debit your income tax and you credit your tax payable. It's an additional tax for you. So you're saying that instead of you to recognize 17.5, you recognize 15,000. So let's make it up this year. So that means you're going to then have to add it to P&L for this year. So your current tax charge in P&L, your current tax charge to P&L would then be 20,500. Okay, so I feel that you need to appreciate something. You need to appreciate that as far as 2017 is concerned, your liability in 2017 is this 18,000. So we would expect that what we should find in the statement of financial position is actually this 18,000. Is actually this 18,000 because that's your liability. While this underestimation for tax is, yes, the additional tax you have to pay, and would expect that you pay that one this year. You pay it this, you would have even settled itself, right? That at the end of the year, the only liability you would have is this 18,000. And remember that you will not pay this 18,000 even until when you file your returns in 2018, year of assessment, right? So because of that, what you find your estimate of financial position is this 18,000. While this 20,500 is what goes into your P&L as income tax charge, because these 2.5 should have been recognized to P&L last year, but it wasn't. So you need to do that this year. You need to recognize that this year. So, and let's assume this is the A part of this solution.
Sir,
Yes.
please come again with that 2,500. I did not really get it.
Okay. So this 20,500 is the tax that would be recognized in P&L this year, in the sense that this is the 18,000 relating to this year, the new tax that you owe this year. And this 2.5 is in respect of your underpayment or underestimation of last year. Okay, because you underestimated or underpaid last year. So you need to make it up this year. As a result of that, your total tax charge for this year is 18,000 plus this 2.5, which gives us 20,500. together like
Thank you
that.
so much.
You're welcome. So again, in the second scenario, again, similar to this, the taxable profits, let's say, is 60,000, and your current tax is 30% of that. Again, let's say we need to over or underestimate for tax for 2016. From the question, we're told that the estimate of current tax, is this 15,000. Okay. And the B part told us that the actual tax agreed, what's the B scenario? Is 12,500. Let's say we agreed 12,500. So in this scenario now, it's assumed that you actually overestimated overestimation for tax. Similar to this one is also 2,500. In this case now, the current tax charge to POL is going to be 15,500. It will be a deduction, just like the opposite of overestimation for tax. So because in 2016, your estimate was 15,000, but the taxman said, you're supposed to pay 12,500. Okay, fine. So that means last year we overestimated by 2,500, we overpaid by 2,500. So our tax charge for this year that goes to POL is actually 15,500. Okay. Ufoma, I'm so sorry, I didn't see your hand, Sally. Can you ask a
Sir,
question?
how will you now represent it in the statement of financial position?
Which one is that?
What will
Which of
be
them?
the value for, because it's the same thing you're doing now. How will you represent the value in the statement of financial position?
Yes, now is this 18,000? That's your liability for this year. Is 18,000. That will be your liability at the end of the year, because that's the tax you are owing for this year. Like I've mentioned, for this adjustment you're making for underestimation in this case of A, this one is expected that the taxman will have issued you an additional tax liability of 2,500, which you should settle immediately this year. So, and the entry for that, probably maybe you credit bank and debit an account called underestimation for tax, which of course from this schedule I'm showing you is going to be added to your P&L. You take it to P&L. So that's why, like I've explained earlier, this 25 goes to P&L. So what shows in your statement of financial position as a liability for tax, as your current tax payable, is just this 18,000. It's just this 18,000. Okay. And the same thing is applicable to this one too. Okay, so as far as current taxes is about, you just as soon as you understand this one, that is all for current taxes. Aside the fact of determining taxable profit, this is it. So you just need to understand the reality that the way taxes work in Nigeria is that we are only making estimate of tax for the year. That the whole agreement will happen after you have filed your returns. So when you file your returns, of course, you would expect that, yeah, you go and pay this 18,000 next year. But when the taxman come, know that that's when the actual tax will be agreed. So you will then find yourself in a situation of underestimation or overestimation. So this is how you need to know how to adjust for it with this schedule. Alternatively, I've given you all the debit and credit because it's important accountants are able to speak in debit and credit, which is why I always start with that. Right? Then in your exams, when they ask you things like this, don't start flying debit and credit around, because most of the time they will just ask you what goes to P&L and all of that, and what goes to statement of financial position. So which is why I'm emphasizing that based on this question, in scenario A, it's 20,500 that goes to POL, why it is 18,000 that goes to statement of financial position. The scenario B is the same case. Is 18,000 statement of financial position, 15,005 statement of profit or loss. Okay, so let's take more questions now. Let's take our time to look at this very well and ensure that you really understand it before we move to the next thing. Any questions? Adiola.
Hello,
Come on,
sir.
class.
Hello.
Hello, yeah, I'm with you.
So that means this underestimation now. What about if the company decide to pay it with the current tax? Is it possible? How will you recognize it?
Based on Nigerian tax law today, as soon as they give you letter of intent, sooner they give you letter of intent, it shows immediately on your tax pro marks and you're expected to settle immediately. So there's no way you want to defy it till next year. Otherwise, to continue to accrue interest and penalty. Well, of course, you can owe, and also you can write the tax authority for installmental payments, which is also possible if the amount is material. You can write them for installmental payment but practically you find out that people will just settle whatever it is that's the difference and move on. However, if it's a case of they are not settling, so it means that your liability, in this case A, won't then be 80,000. Your liability would then be 20,500 at the end of the year if you have not settled this. That's just what will happen. It's something we expect should have settled, because it's not something that ends up till the end of the year like that. It's desk review. We should resolve it immediately. So, permission to move on, please. So, on the basis of the above explanation, current tax are recognized in profit or loss, except tax arising from business combination. Okay, where taxes acquired in a subsidiary are treated as part of It's part of the net asset acquired. And also transactions and events that are treated in other comprehensive income or directly to equity. So in this case, the taxes on these items are also treated in OCI or equity, depending on where the item itself is actually treated. So let's go to deferred tax then. So deferred taxes, like I've mentioned earlier, that deferred tax is a tax that is payable or recoverable in the future period in respect of temporary difference. So this is a very clear definition, except the introduction of temporary difference. Which one is temporary difference again? And also, why is there even a tax that is payable or recoverable in respect of future period? So even if there is, why are we bothering about that today? Why not just wait till that time before we actually then recognize that? So majorly these are the issues we need to resolve, and let's see why this actually exists. The right way or the best place to start is temporary difference. That I think is the best way to start, because it's going to explain this what we are bothering about the future today. So temporary difference, this is the timing difference between the amount recognized in the books and the amount captured by the tax authority. Let me break that down. So this is the timing difference between the amount recognized in the books and the amount captured by the tax authority. So timing difference is just differences between when they recognize it. Not that one party will not recognize it, they will definitely recognize it, but it's just a matter of which year. So you can recognize something in your books this year, and the tax authority decides not to recognize it this year and says that he's going to recognize it next year. And these are practical issues. These are things that happen every time in practice. Like I faced one recently with my client. So my client had director's fees and the amount was material. We had it as an expense. So when they brought in their desk review reports, the tax authority says that, okay, can you show us evidence that this director's fees has been paid? Okay, we said it hasn't been paid, right? That they will pay it next year. The tax man will say, no problem. We cannot allow it as a deduction now until it has been paid. So when you show us next year that it has been paid, then we will allow it. Okay, so I mean, of course, yeah, they make sense because that's how taxes work. Otherwise, if they allow people to just enter transactions like that, nobody will pay any tax because you just be putting in all sorts of expenses that will never get paid, and it will be a loss to the tax man. So those are it's something that happens year in, year out in almost every organization. So what is then happening is this, right? In our accounts, that director's fees will still be sitting there, but the tax impact of that has not been is not going to reflect because the taxman is not going to allow it as a deduction. So the tax is not there for this year. If you allow that fly, if you just sit down and gloss over that, that would be wrong. That would be wrong in terms of accrual accounting because accrual requires that that expense, the tax impact of it, all expenses, their tax impact must be recognized this year as income tax. That's accrual. We need to recognize and book everything this year. So, but since it's not going to reflect in our current tax, okay, and we know that when we pay these directors' fees, the tax man will allow it as a deduction. We're going to enjoy it in the future. Okay, so but since the transaction happened this year, we usually need to accrue for that tax this year, even though we are not going to get it this year, but we still need to accrue for it. So, and that's what we call deferred tax. That's a tax that the taxman is saying that he's not going to allow this year. Okay, that let's accrue for it. So we call that deferred tax. So eventually it's going to nil off when it's eventually settled. But at least when the taxman eventually allows it, but at least it's there. We have done our own full accounting, right? We have done our own full account. We have accrued for. So when we say deferred tax, is more of saying accrual for tax. And the taxman says he's not going to capture this year, then let's accrue for it. Because if you don't show the tax impact, that means you are not applying accrual concept fully. Because your tax, your current tax, your income tax must reflect all the tax effects of all your transactions, except if those transactions are tax exempted. Otherwise, you need to show the impact of it. So anyone the taxman says, okay, I'm not allowing this year, I'm not going to tax this year, but I'm going to tax it in another year, you need to accrue for that tax. You still need to show the tax impact because the economic activity happened this year. It's expected that you show the tax impact this year. I hope I'm making sense. If you really get that, that is deferred tax. So, and going back to this definition, I said this is a tax that is payable or recoverable in the future period in respect of temporary differences. And I said this temporary difference is the timing difference, right? Because it's a timing thing, really. So between the amount recognized in the books, meaning in our own records, and the amount captured by the tax authority. So I can say that usually we can refer to the amounts recognized in the books is known as carrying amounts. Amount recognized in the book is known as carrying amounts, while the amount captured by the tax authority is known as tax base. So we can redefine temporary difference, which is how you find it in most textbooks that this is the difference between the carrying amount and the tax base of an asset or liability. Okay. But if you really want to understand what is going on, follow this. This would help you to a great extent. Then you can then come to this like that. Okay, so that's temporary difference. Now, if you understand temporary difference, so there are two of it, which of course makes sense too. So one could be the one that will result in you recovering tax or getting a deduction, like the scenario I gave you, where the taxman says that, okay, we won't allow this expense until you pay it. It means that in the future, you are going to enjoy a deduction in respect of that transaction. Because when you eventually pay it, the taxman allows it as a deduction, then you pay less tax. So we usually will call that a deductible temporary difference. Deductible temporary difference. So this is the tax, or this is temporary difference. This is temporary difference that results in recoverability of tax in a future period. While the other one that can result in you paying additional tax in the future, paying tax in the future. It's just like saying you have a revaluation surplus and the taxman says, this revaluation surplus, we cannot tax it now because you have not actually earned it. There's no cash to back it up. So we're not going to tax it now. When you sell the asset and you actually earn this surplus, then we'll tax it. So that's a taxable temporary difference. So this is like the temporary difference that results in tax payable in future period. This is the temporary difference that results in tax payable Okay. So additionally, we have deferred tax assets. So deferred tax assets. So this is a deferred tax that arise from a deductible temporary difference. So deferred tax assets is a deferred tax, or let me call it this, a tax that is recoverable in respect of a deductible temporary difference. While there is, in fact, there are more than one issues. Let me quickly tell you the deductible temporary difference, carry forward of unused tax losses, and carry forward of unused tax credits. So for deferred tax assets, this one, you would recover it in respect of deductible temporary difference. So when you have a deductible temporary difference where you are going to get a recoverability of tax in the future, right? You would account for that as a deferred tax asset, right? But when it comes to deferred tax assets, is beyond deductible temporary difference alone. It could also be as a result of carried forward of unused tax losses and also carry forward of unused tax credits. So if you have tax losses, okay, when you have a taxable loss, so the Nigerian law allows you to carry it forward to the next year. You can carry it forward to the next year. And when you carry it forward to the next year, you can net it off against your accessible profits in the future. So unused tax losses also gives rise to a deferred tax asset because you are going to recover some tax. The tax you pay will be lower. The same thing for tax credits, like when you have withholding tax credit, you can also use that against your future income tax. So all of that, you account for them as a deferred tax asset. And also for deferred tax liabilities, so this is a tax that is payable in respect of taxable temporary differences. In respect of taxable temporary differences. Okay, so that's the background to deferred taxes. Now, from all I've said so far, the most important thing here that when you understand it, everything is settled, is this temporary difference. This definition I gave to you. As soon as you can follow through with that, then every other thing is just coming out from there. Because when you understand temporary difference, then you would be able to relate to deductible temporary difference, the one that will result in deductions in the future, or taxable temporary difference, the one that will result in paying additional tax. And when you understand that, then you know that when you have deductible temporary difference, the kind of deferred tax you will get, you would recognize in the books is a deferred tax asset. When you have a taxable temporary difference, the type of deferred tax you recognize in the books is a deferred tax liabilities. And that's really everything. So, you see, popularly, examples of temporary differences that you might have, a very key example is provisions. This is a popular example, provisions. So when you recognize provision in the books, the taxman would not capture it. The taxman will not capture it now until you actually show that you will pay it, until you actually show us that you would pay it, or until you pay it. So temporary difference arise from provisions. Another one is depreciation. when you recognize depreciation in the books, the taxman will not capture this. So, though the taxman will capture something else immediately, but what he will capture is capital allowance, and the amount will be different. So the differences in those amounts is also a temporary difference. Is also a temporary difference as well. Another one is revaluation surplus. When you put revaluation surplus in your books, the taxman will not capture it. They will capture it when you actually earn it. That is when the taxman would capture it. So there will be a temporary difference between when you put it in your books and when the taxman will want to capture it. Another one is impairment loss. Impairment loss, or let me call it revaluation deficit. When you have an impairment loss, like I taught you in IFRS 9 and IAS 36, the taxman will not capture this. They will say until you actually lose that money, until probably the receivables go bankrupt or something happens that you cannot, they will not capture it now, but they will capture it later in the future. So impairment loss or evaluation deficit would also result in temporary difference. Another one is development costs in line with IAS 38. IAS 38 requires that when research and development costs meet certain criteria, IAS 38 says you should capitalize it. But the taxman would expense everything this year. They will allow that expense as a deduction this year. They will say, okay, allow it as a deduction this year. But what you put in your books is just the amortization relating to that year. But the taxman would allow the entire amount because it feels that you have paid it. It's a sunk cost. It's an amount that you have already paid. It would allow it for you. And the list goes on and on like that. But the substance is what you should look at, not cramming all of these lists. Looking at, okay, this is what you have in our books. This is what and when the tax authority will capture this. So, example of items that are not temporary different. I think it's important because there are some you will mistake for temporary difference. And the examiner knows that, then they will post it to you. But you need to let me tell you that they are not actually temporary difference. Number one is, in fact, the major one are exempted income. Okay? Exempted income or exempted income or items that have no tax consequences, like grant income, for example. Now, when you have grant income, they are usually not taxable, they are usually exempted. Or when you make donations to a recognized body, they are usually not taxable. They have no tax consequences. So when you have items like this that have no tax consequence or they are exempted, okay, these items are a permanent difference, and it has no deferred tax consequence. It has no deferred tax consequence. Okay. Now let's solve some questions on that. Okay. I have plenty questions. So who is going to, okay, let's read for us, please.
Okay, can I read now?
Yes, please.
Okay. Good questions. Okay. Let's look at examples on identifying the tax. Okay, a machine costs 5,000 naira for tax purposes. Depreciation of 1,500 naira has already been deducted in the current and prior periods. The carrying amount is 2,500 naira. What is the deferred tax?
Okay. So for this one, we are asked the deferred tax. So the first thing we need to get before we can derive deferred tax is to know what's the carrying amount. What's the carrying amount? And here, for an asset, the way carrying amount is determined is, like I told you, for this case, is the amount that we recognize, that we capture in the book. So for assets, the way we will have captured carrying amount is cost minus accumulated depreciation. At any time, any day, this is how you capture carrying amount. So from here now, if I may ask you, what's the carrying amount of this asset?
3,500.
5.
Okay, 3,500, but it's actually 2,500 because they told us in the question that the carrying amount is 2,500. So this one you're saying is not depreciation, no. It's actually capital allowance, because the question said that for tax purposes, depreciation of 1.5 has already been deducted. So it's in Nigeria that we have capital allowance. It's in Nigerian law that we have capital allowance. In many other countries, they don't know what they call capital allowance. Capital allowance is not their thing in many other countries. And this is IFRS. It's not about Nigeria, it's about a lot of countries. So that is why, so be very careful and note this. So when you see them referring to capital allowance, which we call it in our country, they would tell you that for tax purposes, depreciation is this. Then you should know that they are talking about capital allowance. Or they tell you that the tax depreciation is this. That's capital allowance. So don't interpret that as capital allowance. So this question has given us carrying amounts directly, so you don't have to bother calculating it. But our tax base, which is the amount the taxman will capture, is actually the costs minus that accumulated capital allowance, which is going to be the 3.5 you mentioned. So in this case now, we are capturing 2,500. The taxman is saying that it should be 3,500. So as far as this asset is concerned, there is a temporary difference here. Abi, based on what I've explained, a temporary difference of 1,000. A temporary difference of 1,000 from what I've explained so far. So the key thing for you to determine your deferred tax is for you to know whether this 1,000 is a taxable temporary difference or a deductible temporary difference. Because a taxable temporary difference will result in a deferred tax liability, while a deductible temporary difference will result in a deferred tax asset. In this case now, based on what I've explained to you so far, should this be a deductible temporary difference or a taxable temporary difference? Who can tell me?
Taxable, sir.
Michael said it's taxable. Any other trial? Before I come back to why you're going for your answer. Any other trial? Michael said it's taxable. Okay, if we don't have any other response, so Michael, why do you think it should be taxable temporary difference?
Because the tax base is more than the carrying amount, sir.
So how does that explain that? It should be taxable.
Sir,
No, you don't. Let me cancel it then, because you don't know why. So the way I want you to think of it is that for taxable temporary difference, it means that in the future, we will pay additional tax. For deductible temporary difference, it means that in the future, we will pay less tax. For you to say this is a taxable temporary difference, that means you must have seen somewhere that we would pay more tax. So from this, so don't just tell me it's this because tax base is greater than this. No, me, I won't teach you in that manner because it's a recipe for failure. If you forget it, that's a problem. So you won't come in my class because you don't come to pass ICANN exams anyway. So let me tell you this one. Now, this is a deductible temporary difference. This is a deductible temporary difference. And the reason is because you have more deductions in the future. So as far as this asset is concerned, we are saying that because to the taxman, whatever it is your asset. The taxman sees it as depreciation. In fact, what it is depreciation you recognize over the life of the asset. This 2.5 means that in the future, we are still going to recognize 2.5 depreciation over the remaining period. But though the taxman does not recognize or will not allow that depreciation, the taxman is saying that, okay, me, I'm going to give you 3.5. So that means on the basis of this, I'm going to enjoy an additional deduction of 1,000 in the future because of this temporary difference. Me, I'm saying, okay, 2.5 in my books. That's what we show in my books. But the taxman is going to give me 3,500 deduction in the future. Deductions. So I'm going to have an extra deduction, an additional deduction over what I've recognized in my books by 1,000. That's how I need you to understand it. That way you will never ever get it wrong. And I already told you that when you have a deductible temporary difference, that will result the
Please go over
resulting
that again.
tax. Sorry?
Please, can you go over that again? I didn't get that.
Yes, of course. So this 2.5 is the amount you would put in your books as depreciation. That's your depreciation over the remaining life of the assets. But the taxman will not allow that. The taxman is saying, I would give you 3,500 over the remaining life of your assets. That's what will be allowed as a deduction. That's the capital allowance you would get over the remaining life. So that means the tax impact of that is that I'm going to have a deduction, an extra. There's an extra deduction of 1,000 here. So this temporary difference is a deductible temporary difference. It will result in having a deduction, an extra deduction in the future of 1,000. So, and when you have a deductible temporary difference, the tax impact of that today, we call that deferred tax assets. And it's calculated by applying the tax rates at the end of the year on that. So when you do 30% of that, it gives you 300 naira. And that's the solution to the first one. So since it was only Michael that attempted this, so let me ask you, Michael, is this clear to you, this explanation?
Yes, I will go over it again. I don't really get the basis, and I don't want to drag the class back. So I will go over it again if the video is released.
Okay, no problem. I mean, you can take our time to look at this very
Sir,
well.
sir, I think
Yes,
my
sure.
confusion is how do I know when there is taxable temporary difference and deductible temporary difference?
So, if you want to start simple, like I've mentioned before, if you're going to get a deduction in the future, if you're going to get a deduction, an extra deduction in the future, like this example I gave you, this provision, I gave you a client of mine that recognize director's fees, but the taxman says, no, we are not going to allow this as deduction. We are not going to allow it. But it's in your books anyways. But since they say they will not allow it now, so it has no tax impact. But I know that in the future, I'm going to get it as a deduction. They will allow it in the future. So when they allow it in the future, I will get that deduction. So we need to recognize the tax impact now. And since it's a deduction in the future, so we call that a deductible temporary difference. A deductible temporary difference. Because it's a temporary difference that will result in me having a deduction or having to recover taxes. But in the case of, let's say, revaluation surplus, where that is an income, in this case, I recognize an income in my P or L or OCI, but the taxman says he cannot tax it because I have not actually collected the money, or he might say I have not actually earned it. In this case, this one will result in a taxable temporary difference because the taxman will charge me to tax in the future. The taxman will charge me to tax in the future when I actually earn this income. So it's a taxable temp because I will pay more tax. So the way I need you to look at it is when you're going to pay less tax or when you're going to enjoy a deduction in the future, that is a deductible temporary difference. But when you're going to pay more taxes in the future, that's a taxable temporary difference. In this case now, the depreciation I'll recognize is 2.5. the deduction I will get is 3.5. So I'm going to have an extra
So you're
deduction.
calling the carrying amount depreciation. You've mentioned it twice now.
Yes, because that is what it is. In this context, that is what carrying amount is. Because a carrying amount of an asset, when you put 2.5 in your books, this 2.5 represents is like depreciable amount. It's like the amount of depreciation you will still recognize over the remaining period of the asset. That's what carrying amount is. Okay. That's the effect of it in your P&L eventually. The taxman will not, of course, does not allow depreciation. What he would give you is capital allowance. The taxman will give you capital allowance. So in place of that, the tax base here, the way you do it is cost minus capital allowance. You get a balance of 3,500. This 3,500 means the capital allowance you will get over the life or the remaining life of this asset. So why you need to understand this clearly is that when it comes to assets, when you have a cost of an asset of 5,000, yes, you capitalize it, you put it in your statement of financial position, but you agree with me that this 5,000, if the asset has a useful life of, let's say, 5 years, you would depreciate it over 5 years. You will be depreciating it annually every year to P&L. So my concern is taxes here, which is why I'm relating it to that. That's why I'm relating it down to what it is in terms of the tax impact, where it will end in. So if I have a carrying amount in my books of 2,500 today, and my tax base, which is cost minus accumulated capital allowance of 3.5. So you as the accountant need to see this, like I'm explaining it to you now, that this means that I'll be having an extra deduction in the future, because this 2.5 represents that over the remaining life of the asset, I will recognize 2,500. This 3.5 means that over the lifetime of the asset, the taxman will give me 3,500 as a deduction. That's how you would interpret it. So let me repeat that to you again. This is 2,005. It could be any amount at any point in time. So this 2.5 means that I will recognize 2.5 to P&L as depreciation over the remaining life of the asset. But the taxman will give me what the taxman is capturing or will give me as deduction over the remaining life is 3.5. So in this case now, I'll be having an extra deduction of 1,000 naira. So that's a deductible temporary difference. And deductible temporary difference will result in a deferred tax asset, which is just 30% of 1,000 as 300 naira. So that's how you should look at it. Any other way you look at it, you probably be cramming it. I don't know. Okay. Do you have any questions?
Okay. Can you hear me?
Yes, we can hear you now.
Okay. Question 2. Interest receivable has a carrying amount of 1,000 naira. The related interest revenue will be taxed on a cash basis. What is the deferred tax?
Okay. So to determine the deferred tax, we will need to get the temporary difference by comparing how much we recognize in our books in respect of this interest receivable. I was told is 1,000. So determining the carrying amount is never a problem. Is never a problem because that's what is in your book. So the examiner will always give it to you. Okay. So the tax base is what the taxman will capture in his own books. So let me ask you. So how much is the taxman going to capture this year in his own books based on the information given to us?
$1,000.
1,000.
1,000. Okay. Zero. The taxman is going to recognize zero in his own books today. And that's because we're told that the related interest revenue will be taxed on a cash basis. So the taxman is saying that this interest receivable, I'm not going to tax it now. I'm not going to tax it now. The taxman is saying I'm going to tax it on a cash basis. So taxman is saying I will tax it when you actually collect this interest. So the guy is not going to he's not going to capture any amount for tax uh, relating to this interest expense. But though he will tax it in the future when we actually collect the cash. But for now, he's saying it's not. I mean, that's what the question actually mentioned. That in our books, carrying amount is 1,000. But these interests to they said the related interest revenue, what we recognize in our P&L, the taxman is not going to tax it until we collect the cash. So I'm sure those that actually attempted, you should have seen why you're wrong. So there's a temporary difference here. There's a temporary difference here of 1,000. So this temporary difference, is it a deductible temporary difference or a taxable temporary difference?
It's a
Taxable.
taxable.
Okay, now we are getting there gradually. At least for the first time in this class, you got something right. That's okay for me. So this is a taxable temporary difference because the taxman says that he's going to tax it in the future. It's simple. It's just it will be difficult for those that don't want to unlearn some things they have learned around this, which is most likely the wrong way of learning different tax. Or if you are not just following the simplicity with which I've actually presented this to you, you find it extremely difficult to get. But it's actually very straightforward. So here now, the taxman is not taxing this item until I collect the cash. So he will tax it in the future. So the temporary difference is taxable. It's a taxable temporary difference. And when you have a taxable temporary difference, that will result in a deferred tax liabilities. You just apply 30% on that difference. In this case, it's going to be 300. Let's have questions, please. Sarat, can see your hand.
The first solution, you're saying that that deductible temporary difference is not what they will pay in the future. It is what the tax authority is giving to them,
Yes.
like an
Yes.
overpayment.
If that's how you understand it, but it's actually a deductions. When they allow your expenses, we call it deduction in tax.
Okay. Okay, so this solution is based on depreciation,
Yes.
what the tax authority is giving to you as capital allowance, as depreciation, right?
Yes, 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 yes.
Okay, I see.
Yeah.
Thank you.
Okay. Questions, questions, questions. Don't sleep. Oh, this is not the best time for you to sleep. By the time I start group accounts with you guys, all of these things, you would need all of them. You would need all of these standards I've been teaching you because you'll be seeing it inside those questions like that. When you start solving past questions, you will see on your question one for your exams. So you need to really get those things very well. Okay. So the guy that I read first, please, what's your name? So I can really easily call you because the name you saved on your
My name is Ifua, but on this call, it's Old Consulting.
I don't want to call you old consulting. What's your
You call me
F4?
Ifua, sir. Yes, Ifua.
F4. Okay, okay. All right, F4. Can you read the next one? And don't F4, don't just be reading. No. Are you
Okay.
getting it?
Yeah, yeah, I'm trying my best. I'm getting it.
Okay, good. All right. Okay, read the third one,
Okay.
please.
Okay, the third one. Trade receivable have a carrying amount of 2,000 naira. The related revenue has already been included in taxable profits, tax loss. What is deferred tax?
Okay. Now, again, to get the deferred tax, we need to identify temporary differences. So we have a carrying amount, what we put in our books of 2,000. They will always give you that in the exam. It's you that will then figure out what's the tax base. I mean, I think that's the major challenge in the exam for deferred taxes, to know what the taxman will capture. Because you already know what's in your books, but what will the taxman capture? So you just need to, and they will tell you, they will give you a clue. Yeah, now they have already told us that the related revenue has already been included in taxable profit. So what's the tax base?
2,000.
Yes,
Zero, sir. Zero.
it's 2,000.
Okay, let's hear from Michael. Why do you think it's zero?
Uh, sir, hello, sir. Can you hear me?
Yes, I'm with you, Michael.
Okay. Uh, sir, hello, sir.
Yes, Michael, I'm with you.
The last one, okay, the last one is interest receivable. You know, I'm just using it to guide myself, sir. Now, here is a trade receivable. You know, it will still be received, but it is not been it has not been received. So
Yeah.
then the tax base will now be zero.
No, that is not how you should guide yourself. You should guide yourself with what the question tells you, except if the question did not give you a clue, then you will have been right. But this question told us that the taxman has already captured it. That's what this question is telling us, that the related revenue has already been included in the calculation of our taxable profits. For whatever reason, the taxman captured it. So if they did not tell us this, then you will have been wrong, you will have been right. Or the examiner gave it to us the way this one was clear. They said it's not just us relying on the fact that, okay, we have not received the money. Yes. So let the question guide you and explain to us whether the taxman has captured it or not. Except if the question is silent, you can then assume. But here, in this second scenario, like you referred to, they said the interest revenue will be taxed on a cash basis. So the taxman did not capture it this year. He's waiting for you to collect the cash. But for whatever reason, for this one, they said the taxman has captured it. So don't, um, I don't know how to put it. Just let the question guide you. So the related
Okay,
revenue
sir.
are included. Yeah. So the tax break is 2,000 because the guy has included it in his books. So in this case now, the temporary difference is what? Zero. Because they both included it, so there's no temporary difference like that. So there's no deferred tax impact. Okay, I4. Question 4.
Okay, question 4. Dividends receivable from a subsidiary have a carrying amount of 5,000 naira. The dividends are not taxable. What is the deferred tax?
Okay, so again, for this one to get the deferred tax, we need to get temporary difference. And temporary difference is comparing carrying amounts. And carrying amounts here, they will always give you. So we're given as 5,000. The tax base, okay. That's what the examiner wants you to determine yourself. So what's the tax base here?
Okay, please, I want to try, sir.
Okay, Michael,
They
try.
said the dividends are not taxable. So the tax base will be zero, according to the question.
You're correct. Tax base is zero. So we are not done. So what's the temporary difference?
It's
Hmm?
500. 5,000.
Okay, so eh, let me shock you. It shouldn't be a shocker because I would have expected one of you to get this right, that this will arise in something we call permanent difference. This is not a temporary difference because these dividends are not taxable. They are exempted from tax. So temporary difference is that, okay, I'm not taxing it this year, I'll tax it next year. I'm not deducting it this year, I'll deduct it next year. That's temporary difference. But by the time it becomes something that is exempted from tax, I think I told you, yeah, examples of items that are not temporary differences. Exempted income or items that have no tax consequences. Okay. And this is an example. So these dividends are not taxable. So it's a permanent difference and no deferred tax on permanent difference. Deferred tax really arise on temporary difference. So you need to watch out for that. Let's look at this one. Can you please read it?
Question 5. A loan receivable has a carrying amount of 2,500 naira. The repayment of the loan will have no tax consequences. What is the deferred tax?
Okay. So to get the deferred tax, we need to get temporary difference. They will always give you carrying amount. They will not give you the tax base. And if they give it to you, congratulations. So now what's the tax base here?
Sir, they said the repayment of the loan will have no tax consequences. So if it's not having a tax consequence, it means the tax base will be zero.
That's correct. That's correct. So yeah, what's the temporary difference?
It has to be a permanent difference since
Thank you very much. And you should now understand it. Permanent difference is 5. No deferred tax consequence. No deferred tax on permanent difference. Okay. let's solve these additional 5 more, then we can go and sleep. Okay. So Sarah, so Michael, you can check with the charts. They are congratulating you. Afua, can you read this one?
Okay. Current liabilities include accrued expenses with a carrying amount of 3,000 naira. The related expenses will be deducted for tax purposes on a cash basis. What is the deferred tax?
Okay. I hope you can hear me. So to get the deferred tax, we need to get temporary difference. And what is our carrying amount here? They always give you is 3,000. What's the tax base? Yeah, now what's our tax base? And
It's
try.
also three, no, 0.
Yeah, that's correct. 0. Because we're told that the related expense will be deducted on a cash basis. So the taxman is not going to capture it now. The guy will capture it in the future. So we'll be having so we'll have a temporary difference of how much? Of 3,000. So now this temporary difference, is it a taxable temporary difference or a deductible temporary difference?
Deductible.
Yes, that's correct. That's correct. So because that's when, I mean, the question told us that they will allow it for deduction on cash basis. So they will allow it for deduction in the future. So it's a deductible temporary difference. And when you have deductible temporary difference, the tax impact is a deferred tax asset. When you apply 30% on 3,000, that will give you 900. Okay. F4, the next one.
Okay.
Wait, wait,
Question.
wait. Hold on. Where's Charity? Hey, Charity, are you still here?
I'm here, sir.
You are too quiet. You should have shouted my name one or twice.
I'm
But I mean,
sorry, sir.
are you getting it?
Yes, I am.
Okay.
Thank
Afua,
you.
welcome. Afua, let's read the second one.
Questions. Question 2. Current liabilities include interest revenue received in advance with a carrying amount of 5,000 naira. The related interest revenue was taxed on a cash basis. What is the deferred tax?
This rainbow is powerful. Okay. They would give us, always give us the carrying amount. So what's the tax base now?
I would say it's 5,000.
Okay, the tax base is 5,000. So that's the challenge with this rainbow they use there. It's actually 0 because this was taxed on a cash basis, means that the cash has been received like last year. So interest received in advance. The meaning of interest received in advance is that you received an interest in advance. It's just like you invested, then the government paid you interests like immediately. They paid you the interest, they paid you cash immediately, like from the date of investment. So you are collecting the cash. So maybe next year you still have it in your books as a liability, but the taxman has already it has already been taxed on a cash basis. So as a result of that, this year now, the guy does not need to capture it again because he has already captured it on a cash basis. So they said the related interest revenue was taxed on a cash basis. So this one is different from the one they are just including in your taxable profits this year. This one is a situation of the one they have taxed on a cash basis. I mean, the meaning is that they have already taxed it in the previous year. So this year, the taxman is not capturing, as far as this year is concerned, the tax base is zero because that's the focus. How much is the taxman capturing this year? The guy is capturing zero. So in this case now, there is a temporary difference because the taxman captured it last year, but you're putting it in your books this year. In that case, so you're not going to enjoy, they have already taxed it. So it's going to be the reverse, which is deductible in this case, because it can be taxable temporary difference. Therefore, it will be deductible temporary difference. So
Hmm.
the way interest revenue, interest received in advance, the way it works, is that you usually debit your bank and you credit a liability as that's how we recognize it. You debit bank, you credit liability. So it wasn't even in your income. It wasn't an income at all. At the date you collected the money, it was not there in your P&L. But because the taxman looked at your cash flow statement and they saw that you collected interest now, cash, so they taxed it that year. So you pay tax that year. Fine. Now, in the year when you have not actually earned it, then that liability then becomes an income. That's the way we account for it. From you debit the liability, you credit income. So that's in this case now, it has not become that. It's still a liability. That's as far as this question is concerned. So why this is deductible now is the fact that when it's an income, you will not even pay additional tax because you have already paid the tax. So that means in the future, there will be a tax reduction for you because you have an income that they cannot tax anymore and you put it in your P&L. So I'm just trying to elaborate it. But if I want to keep it simple, based on what these guys have given me, the carrying amount is 5,000. The tax base this year is zero because it has already been taxed on a cash basis. So I'm not putting it in my books this year. So this temporary difference now, since it has already been taxed and it won't be taxed again, then it will be deductible temporary difference, the reverse. And when you have deductible temporary difference, that will result in a deferred tax asset, which is 30% times 5,000, give us 1,500. Okay, what's time? 10:38. So let me just stop here. So let me allow you to try 3, 4, 5. You can just try 3, 4, 5 yourself. Then we have a lot of questions to solve. So the whole of Saturday, I will solve as many questions for you as possible. And do you know the shocker? Shocker is that there will even be more I will keep for you later when I teach you business combination. Because if you remember, when I taught you share-based payments, I told you that there is a deferred tax implication of share-based payments, right? So I'm still going to go back there again because share-based payments also, that expense you are recognizing in your books, if you remember, the taxman will not allow it. The taxman will not allow it because the taxman you say that you are putting expense as staff costs. Have you paid this share option? Have you paid it to them? You will say no. Taxman would. So you will see that that share-based payment will result in a deductible temporary difference too. So I will come there, but I really need you to understand this deferred tax very well. Not only that, when you understand it very well, you need to also understand the deferred tax implication in business combination from the perspective of fair valuation of asset and liabilities of the subsidiary, from the perspective of undistributed profit of the subsidiary, from the perspective of unrealized profit recognized in the books of the subsidiary. All of these have deferred tax impacts. But I'll come to that. I won't rush you. Let's focus on the core principle now. Understand it very well. Then we will start applying it here and there, here and there, here and there. And we're going to solve sufficient past questions just for you to get used to it. Me, I will do my parts, but the part me I will do is never going to be enough until you sit down to do your own part. I'm sure you know that, but that's a story for another day anyway. So I'm going to stop here for today. Do question 3, 4, 5, the first Saturday, right? Then we will correct it. We will do the corrections. Then we will solve all of these questions in this handout on Saturday. All of this. Then we'll do more in terms of applications. Do you have any questions? Okay. I think I can see maybe today is one of our toughest class in terms of you understanding it. It's quite understandable. It's okay. So just make sure you revise it so you can get it very well. Thank you very much. I'll see you Saturday. Have a wonderful
Good night,
day.
sir.
Thank you, sir. Good night.
Please,
Thank you, sir.
Good
I used to
night.
have to set up immediately after this.
Bye.